Hello, you're watching Proactive. I'm joined by Stephen Lilley and Matt Ridley from Greencoat UK Wind. Stephen, Matt, you're out with your half-year results today. So, Stephen, I'm going to start with you. Could you give us an update on your performance in the period?
Yeah, no, thank you, Stephen, and thank you for having us on. So we produced 2.7 gigawatt hours of power in the half. Slightly down, wind was down a little bit. We had some availability issues, predominantly on Hornsea 1, which we talked about previously. But cash generation of 165 million, 1.5 times covered. So even in a period of some downside, effectively, still really well covered. So delighted with that. From other sort of aspects, increased the dividend by 14.2% versus RPI of 5.2%. So that's one of our promises to continue to do that increase with RPI or above. In addition to that, we have paid an additional £29 million of dividend to take last year's dividend up to 10 pence per share, and have bought back £53 million of shares. So £82 million in addition to the dividend promise that we've got. And I guess sort of finally, we're trading at a discount still a little bit. We always want to remind investors that the return on our business of 10% on NAV to shareholders post fees, etc., is extremely good for a business that lacks volatility, if you like. 6% north of the long-term gilt rate. So a period where as an infrastructure investor, in one sense, not a lot has happened. That's good. Very stable dividend, cash back to shareholders, good return to buy in at.
Matt, how about the overall market developments, including the recent change of government in the UK? What does it mean for Greencoat, and where are you seeing opportunities here?
I think it's a good point just to step back and remind people of the relevance of the company. So it was originally created to solve for investors, industry, and society an attractive return to investors, a means of recycling capital for industry, and all of that goes into the pursuance of net zero as a goal for society. And UK Wind has served to crowd in capital. If you don't have a long-term owner of these assets, there's little incentive to build them. And we're now the fifth largest owner of wind in the UK, really just behind the utilities. So against that backdrop, I think Labour's moves thus far are very positive, both the policy commitments to accelerating net zero, and importantly, just the immediate actions that have been taken in pursuance of that goal. Firstly, to remove the de facto ban on onshore wind farms in England. That isn't necessarily transformative for our business, but gives you a good statement of intent of delivering on policy. Wind is really the key driver in getting to net zero. We think it's already a £100 billion market. We think it was likely to be another 75 or 100 billion in the next 10 years. That really could now be a 275 billion pound market in the next 5, 6, 7 years. That's a material market. And that's a great opportunity for us. You need all the forms of capital you can get to own these assets over the long term. And that's where we're really well positioned with our scale and our performance track record.
Stephen, take us through your capital allocation strategy in this environment.
Yeah, because in one sense, what Matt's talking about is the medium to long term, where we are extremely well placed in the sort of scale that we've got. In the short term, obviously, we're trading at a discount, so we can't quite get to the sunlit uplands, if you like. But while we're in where we're in, we've got a lot of cash generation, but we can't go around that cycle of buying new assets, refinancing in the equity markets because they're not open to us at the moment, trading at a discount. So capital allocation is key for the short-term activities. So we've done that by increasing the dividend more than by RPI to give shareholders back through dividends, but also buying back shares. Relevant thing for us to do because it's a really good investment buying back at a discount. And then our focus has probably been on disposals, not acquisitions, if you like. So we're progressing those, and we would hopefully sort of do some of that going forward in the short to medium term, and then repaying the revolving credit facility down. We're very happy with 39% gearing, even though we have a 40% cap, because gearing for us is the cost of debt at just a 4% and a bit is a long way south of our return. So actually leverage is good for us. But actually paying the RCF down, it's really that probably to some extent gets the balance sheet ready for those sunlit uplands when we can get it back into a more normal environment. The difficulty, I guess, is we feel that returns should, even in the current environment, mean that we're trading at a premium because we've got probably a lot of multi-asset sellers across the whole sector. With UK Wind being the size it is, nearly in the FTSE 100, we have great liquidity, and therefore people come and sell if they need. Multi-asset funds come and sell UK Wind for issues of liquidity.
As a listed business and an investment opportunity, how are you positioned for the current environment then?
Yeah, so I mean, to some extent, all we can do the short-term capital allocation work that we're sort of talking about, and then we can price NAV properly. And Matt and my job is to price risk properly, and that's what we do. And so therefore, having the right discount rates, having the right return on the business should be taking the particular market dynamics out of it, which when you start to get inflows back into the UK, as we start to see. That should very quickly sort of flip. So I think for us, with the return we've got, which at NAV 6% north of the government gilt, a business that then pays a dividend that increases with RPI, obviously inflation important to protect, also preserves NAV on a real basis, quite important to have. And if you look at our business of a billion something dividends paid over the last 11 years, and nearly the same in terms of reinvestment. Hugely important. I think for us it's sort of important to, once it's drawing all these things together, the market that Matt is talking about, the size that we are, when we can get back into that place, we're a key part of getting to net zero. Yes, for investors we can provide that, but yes, for utilities effectively recycling so that more build out can happen. And so that we can get towards net zero. So returns should be good, and is satisfactory in the current market. But when we get back into that sort of more normal market, we would fully anticipate to be one of the key drivers for the move towards net zero. So we welcome the Labour announcements and targets, because we should be part of that, and we're looking forward to doing that.
I hope you'll keep us posted on your progress. Thank you both very much for speaking with me today.
Thank you.
Thanks, Stephen.
Stephen Lilley and Matt Ridley from Greencoat UK Wind.